Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by partner and chief economist Don Rissmiller to talk all things economy. Don, how are you doing today?
Very good, Ross. Good to talk with you.
Great to have you as well. Obviously, a tumultuous week here. I think we can hone in on at least two things up front. One, the risk of a recession in the U.S., and then two, the Federal Reserve's positioning with interest rates in respect to the inflation and labor market picture. Let's start with the former. We've gotten a few soft employment reports, some mixed economic data over the last couple of months. How are you thinking about the odds of a near-term U.S. recession as we sit today?
So, Ross, I would say the odds right now are probably about 30%. And so it's still not the base case because the cracks we have are small cracks, not big cracks in the labor market. So we wanted the labor market to normalize, and we've seen job openings come down, and we've seen some rise in the unemployment rate, but we haven't seen the employment to population ratio decline dramatically for the prime age workforce. And so that's something we would typically use as confirmation of a big crack, and we haven't seen that yet. Also, when we look at firing activity, like jobless claims every week, this week was reassuring. So there are issues, there are reasons to be careful here, but to say we're in recession right now, I think is too big a leap.
Yeah, I think one of the lessons, as always, is the markets are more volatile than the underlying fundamentals will. And so small shifts in the economic outlook can cause big ripple effects in the markets. The second part of this is the Fed's positioning. They've obviously raised interest rates aggressively to combat the historic inflation we saw over the last couple of years. Are they behind the curve at this point? And what do you expect from the Fed for the remainder of 2024?
So I think it's fair to say the Fed is behind the curve. If they had the data we now know at their last meeting, I think they would have cut rates. Now, having said that, the markets moved ahead of the Fed here, so market interest rates have come down. So right now, I don't think this is a very large policy error because the market is doing some of the work for the Fed. What the Fed has to do over the next several weeks is start to validate some of the market expectations that yes, the dual mandate matters, that yes, the employment data really matters here. It's been about inflation for several years. That has to shift. The language in the last FOMC statement set that up, and I do think we're going to make that shift. But that's the challenge right now. The Fed should be cutting interest rates. We should have a neutral monetary policy quite soon here, given that we are seeing some cracks in the economy.
The idea that lower interest rates will spur economic activity. Where are you looking for that? If we're looking for green shoots as far as lower interest rates spurring some activity that has been on hold, would you look in the consumer sector, housing, something like manufacturing? What is something that you have your eye on as to whether this drop in interest rates or this anticipated drop in interest rates will actually be having the desired effect and keeping the U.S. economy out of recession?
So I think there are two areas to focus on. The first is housing, and the second is manufacturing. Both of these would be considered interest rate sensitive sectors normally, and we have seen weakness already. Look at existing home sales as an example. We have existing home sales numbers that are down so low, we have to look at the pandemic or we have to go back to 2008 to find numbers that are close to comparable. And so even when the economy was locked down and no one was moving, you had existing home sales numbers that were better than what we're seeing here. So housing has been frozen by what's happened with interest rates recently, and I think you could see some thaw there. Also, manufacturing has had a tough 2 years. If you look at some of the survey data, like the Institute for Supply Management numbers, it's been a tough 24 months for manufacturing. And this has been a global story as rates have come up globally from many central bank policy stances. And so if that starts to reverse, I also think you should get a relatively quick reaction within the manufacturing data as well.
Okay, so takeaways from here, we're watching labor market, initial claims, we're watching housing, and we're watching manufacturing. Don, thank you so much for the time today. Really insightful at a critical moment, and we'll hope to talk to you again soon.
Thanks, Ross.